Hey everyone, excited to be back for this week's edition of Frequently Asked Questions for Commercial Real Estate. In today's video, what I want to do is talk about a term that is readily used in the commercial real estate investment space, and that is what exactly is an equity multiple. So we're going to explain what that term is and then how it's presented when you are, in fact, trying to either raise capital for commercial real estate deals and trying to give people a perspective on the type of return they could expect over the whole period. Now, before we dive into this video, I greatly appreciate it if you could like and subscribe to the channel. It really does help with the YouTube algorithm and ensures more and more people can hear this message and learn about the many facets of commercial real estate. So now you've done that, go ahead and like and subscribe below. Let's go ahead and dive into this episode. All right, so the question is, what exactly is an equity multiple? So an equity multiple is a term that describes the total return relative to your initial investment. Now, equity multiples don't account for time value of money, which I know we'll talk about later on in this particular episode, but essentially, it is a very basic term that describes the amount of money that you would essentially be receiving over that period of time that you hold the investment and what multiple that is of your initial investment. So let's go over a very high level example so you can understand what I'm trying to describe. So let's say that you are a limited partner in a deal and the general partner comes to you and says, hey, for this particular opportunity, you would need to invest $50,000 of your money, and over the period of time, let's say it's a 5-year hold, we're going to distribute cash flow to you in as a percentage of the total investment. And at the end, once we sell the asset, you're going to receive some of the sales proceeds based on your pro rata share of the ownership interest in the asset. So what you would do is you would hand off the $50,000 to the general partner once you've signed all the requisite documents. And then throughout that whole period, let's say that over 5 years, you receive $25,000 in cash flow. So just to make the math simple, you receive $5,000 in cash flow every year on your $50,000 investment. And then after the 5 years is up, the GP decides to sell the asset, and the money that comes back to you at the end of that 5-year hold based on the sale is $100,000. So over the course of you holding that investment, you would have received $25,000 in cash flow and then an additional $100,000, which is your return on capital, right? You receive your $50,000 flat back plus the additional, the amount that is left over after the sales proceeds based on your pro rata share of ownership. So in total, you would have received $125,000. So to calculate your equity multiple, you take the $125,000 divided by the $50,000, and you're left with 2.5 times your money invested over that period. So why would that particular value be of interest to you? Well, it's a holistic approach when it comes to looking at an investment. So when you're looking at an investment opportunity, maybe you consider the cash on cash return, which is the money that you receive on a yearly basis. So if cash flow is important to you, right? If you want to prioritize receiving cash on a yearly basis, maybe that's a metric that you assign a higher value to. There's also the internal rate of return, which takes into account time value of money. So how long does it take you to receive that investment over a period of time? And it accounts for that in the analysis. So that's also a piece that you could potentially consider. And then the equity multiple comes into play as well. So it's not necessarily a one-size-fits-all approach. If you look at an equity multiple, you say, okay, well, that's a good investment because the equity multiple is 3 times my money in that period of time. It's important to look at it in a more granular level because, as we'll see in this next example, your equity multiple could be a large equity multiple, but maybe your cash on cash return is very low. So what that means is that, maybe you don't receive almost any distributions throughout the whole period. And then the bulk of the money that you receive is at the end once you sell the asset. So depending on what your goals are as an investor, maybe that's not as attractive to you. So that's why it's important to look at it from a holistic approach. And we'll go through a brief example to kind of describe what we're talking about. So let's say we go back to a new example where you are investing $100,000 into a particular investment. And over that hold period, you're going to receive $200,000, whether that's cash flow that you receive, plus the sales proceeds. So your equity multiple in that situation, and this is going to be a 3-year hold period. So your equity multiple in that situation would be 2x. And in this case, I already did the math on the internal rate of return. The internal rate of return is going to be 25%. So in these two examples, you're going to have the same equity multiple and the same internal rate of return, but based on the A and B example, the A example is going to have a different cash on cash return than the B example. So In the first scenario, you would invest your $100,000 into the deal, and your cash flow in year one would be $10,000. So your cash on cash return, $10,000 divided by $100,000 will give you the 10% return. Year two, you're going to receive $15,000. So $15,000 divided by the $100,000, that's going to give you the 15% cash on cash return. And then in year three, you're going to receive the remaining balance of what you would be owed based on the equity multiple that I presented. So that's 2x. You're going to be receiving $175,000 in proceeds, return on capital plus the proceeds of the sale. So in total, your equity multiple is going to be 2x. Your internal rate of return is going to be 25, and your cash on cash return for these 2 years, your first year is going to be 10, and your second year is going to be 15. So those are still pretty good cash on cash returns. But let's go to the second example to kind of provide you with some context. So in the second example, you invest the same $100,000 into the deal, but now in your first year of ownership, you're going to receive $25,000 in cash flow from the investment. So $25,000 divided by your $100,000 initial investment, that gives you a 25% cash on cash return. And this, let's say in the second year, you're going to receive $35,000. So what is that? How do you calculate the cash on cash return? $35,000 divided by $100,000, and that gives you 35% cash on cash return. And then in year three, you receive your initial investment back plus the additional sales proceeds, which in this case would be $140,000 instead of the $175,000 in the first example. And what do you know? Your equity multiple is going to be the same, so 2x. Your internal rate of return is going to be the same at 25%, but your cash and cash returns are going to be different. So based on these two investments, depending on what your goals are as an investor, maybe you want to prioritize getting your cash flow because maybe that's something that you're going to use to live your lifestyle or whatever else. So in that case, maybe you're going to want to have the cash come in earlier, in which case the B investment is going to be one that you're more interested in versus the A investment. So just because an equity multiple looks attractive, you really have to dig in a little further to get an understanding about how the cash flows and how everything kind of fits together so you could make an educated decision on which investment you ultimately want to pursue. So again, going back to the beginning, the equity multiple is the total return relative to your initial investment. So if you put in your initial investment of $50,000 and you receive $100,000 in cash flow plus sales proceeds and return on capital at the end of the investment, then $100,000 divided by $50,000 is your 2x multiple. So that's kind of high level math about how equity multiples work. Hopefully you gain some value from this video, and it kind of gives you perspective on one of the terms that you would want to look for when you're looking at investment opportunities, because it can be helpful. If you guys are looking to buy, sell, or lease commercial property here in Louisville, Kentucky, and the surrounding areas, I'm a commercial broker in town that's licensed not only in Kentucky, but Indiana, and we've done deals in Ohio and Tennessee as well. So feel free to give me a call at 502-536-7315, or you can reach me via email at raphael@sumcg.com. Along with that, if you guys like this channel, please like and subscribe. It makes a huge impact on our ability to reach a broader audience, and we greatly appreciate the support. Thanks again so much for tuning in, and we'll see you all next time.